What's going on YouTube? Corey Smith here, CoreFX. I just want to bring you guys a little tip here, a little trading advice, a little insight into the markets. As you all know, trading is a collection of human psychology. Thousands and thousands of traders and bankers and you name it around the world, all speculating on the markets, all investing, buying, selling for this reason or the other. And at the end of the day, whether it's algorithmic trading or human trading, it is all psychologically involved. Human psychology plays a huge role. And a lot of the movement and patterns and Elliott waves and impulses and things of this nature are caused by these emotions. The human emotions can be seen in the markets. And a really good example of how relevant human emotions are in the markets is what we've seen the last 2 weeks in the equity markets in the U.S. Really around the world, but I'm going to use the U.S. markets. So in front of me, I have a chart of the S&P 500. It is a index of 500 of the top biggest companies in the United States, averaged together to show an overall representation of the move and value of these companies. So what this attempts to do is represent the overall stock market. Now, the stock market is separate from the economy. Even though the stock market's been tanking the last 2 weeks, the economy is doing great still. This is totally separate from the economy. They are intertwined, like everything in the financial markets are, but stock markets are different. And with the stock markets, they are a collection of psychology, like I told you guys. And as you can see, for really, let me switch it to a weekly chart, the last almost 10 years, we have been in a bull market. You can see the crash here of 07, 08. We double topped here, and we crashed, right? You can see we bottomed out down here with a V bottom, inverse head and shoulders somewhat. And since then, early 2009, we have been ripping higher. Okay? So it's 2018. So we're in a 9-year bull market, right? We are at what economists refer to as late in the cycle. So there are cycles in the economy. There's booms and there's busts. And we've been in a boom since the last bust. There was a boom before the last bust. Late 90s, there was a boom before the bust. So you can see the cycle moves and moves and moves. And we are, if you look at the last two booms, from here, early 90s to late 90s, early 2000s to late 2000s, 2007, 8, 2008, 9, to now, 2018. So we are in the late end of the cycle. Now, along this uptrend, you guys can see that there's nice and steady booms and then rallies and retracements, rallies and retracements, rallies and retracements. It's nice and steady, right? There's some explosive moves to the upside, but it's mainly, just nice moves, okay? The last few weeks, the last few months, last year really, all through 17, you can see we had a pretty parabolic move upward, and then the last few months you can see we really started to move upward fast. Now, where the human psychology aspect of this comes in, this has been a great market, right? But the masses know that this has been a long-running bull market, and it's late in the cycle. And a recession or a downturn in the economy, in the stock markets, are inevitable. That is just part of how the cycles of the economies work, and as long as they have been tracked, this has been true. So it is pretty much known that there is a downturn coming. Now, with these explosive moves upwards, look at the size of the green candles. And then when you see big red candles like this, like this, like these, look at how much bigger they are than the green candles moving up. What this is telling us is there was much more selling off much faster here than there was buying and accumulation here. So, how does this tell us psychological? When the markets are doing good, yes, everybody and their mother wants to invest. They want to call their brokers. They want to get their money into accounts. They want to buy. However, when markets start to downturn, when markets start to fall, especially in a time like this, the emotion of fear overpowers that of greed big time. So with this market ripping higher like it has been, when we had this sell-off last week, it scared the hell out of people. It made people start calling their brokers. Made people start calling their friend that manages their money. Made people start going into their 401ks, going into their own trading accounts, and making decisions to protect their capital. When the market starts to downfall, it sells off much, much stronger than when we're in an uptrend. Okay? So when we're in an uptrend, we've seen these nice steady moves. Here was very parabolic moves, and this one candle here still engulfed all of it. Two candles here engulfed months. All of the gains and more from this year so far have disappeared. And it's all from these two candle crashes. And this is fear. This is human emotions seeing the market downturn and thinking it's the end of the world. They're going to lose all the money they have in the bank, all their money they've been saving their whole life, all the money they just gave to Jimmy John to buy them some stocks because the market's booming and they don't want to miss out. Now, when this fear triggers, everybody pulls their money out of the markets as fast as they can and puts it into gold, puts it into cash, puts it into bonds, puts it into safe assets. This is why we see very extreme sell-offs like this when we have the market downturn. Now, in the foreign currency markets, this isn't so much the case because it's a pairs trade. Whenever you're buying or selling a pair, you are buying or selling something else in return. So with the stock markets, you're buying and selling. With the S&P 500, you're buying the S&P 500 when you buy it, and you're selling it when you sell it. Or you're buying a stock when you buy it, you're selling it when you sell it. In Forex, you're always doing one versus the other. How this translates to the foreign currencies is the Japanese yen specifically. The Japanese yen is what we call a risk aversion or risk off currency. When there is risk in the environment, whether it be politically, economically, militarily, natural disaster, when there is something that spooks the market or causes uncertainty or scares people, money leaves things like the stock markets and goes to the Japanese yen and gold, but the Japanese yen. So when we see these kinds of moves and we see fear like this, the Japanese yen is typically going to react the strongest and the fastest. Now, correlations in foreign currencies are constantly dynamic. They're constantly changing and evolving. So there can be times where the yen isn't responding as much. There can be times where the yen is responding. Basically, it is all dependent, but the yen is definitely tied to risk on and risk off. And as you can see here, we had this strong yen move, strong up, off of the market starting a downturn. Then they came back down because the markets recovered, and it looked like they were going to be okay. Now we had this crash. Look what the yen's doing. Look what we got here. Right? So the yen is starting to make a bullish move. Now, this whole area has been resistance. Price has been trading under it since November of 2016. So over a year, right? This breaking would be a significant break. Price breaking above this level would be significant. With the S&P 500 looking the way it does, if this sell-off continues, we could see the yen bust out of that range and this resistance and some very strong sustained moves out of the yen. Now, anything could happen in these markets, and this could change the drop of a hat. However, when you have fear kicking into the markets and all the mass psychology of the people whose monies are involved, all the brokers getting calls, all the guys with a huge book of business that their gains are now falling out from under them, who want to get out of their stocks and get into something safer, protect their capital, they're all moving in a fury. And that is exactly why we see this drastic of a move. When you look, this is a historic move. This is the strongest moves we've seen in years. Just look at this. Look at these 2-week moves and then compare it to any other 2-week moves there are, or any other week moves, month moves, whatever. Any other correction. It's bigger. We can keep going back. It's bigger. The last time we've seen even close to this was 2009. Here, bang. The recessions, when the big moves happened, this is what we saw, right? Now, we are seeing this big of a move happening in the equity markets currently. With that being said, the last market crash we had in the 90s was the bubble, the internet bubble, the dot-com boom bubble. Now we had in 07, 08, we had the housing market crash, subprime mortgage loans, all the defaulting on all the mortgages, assets backed by subprime mortgage loans defaulting, and we had a huge crash. All the banks needed to be bailed out. We had a huge market crash, huge recession in the economy followed, and that was the Great Recession. Now, that being said, we have a very strong correction. We have a crash going on, but the economy is strong. We're at 4% unemployment. Wage growth we've seen increasing for the first time in years. The jobs, we've had just had our jobs report beating expectations. We've had a very solid job market. Inflation's not too high. It's not at our target, but it's not too low. Up until now, the job market's been booming. The economy's been booming. We're in a low interest rate environment. The Fed's been hiking rates. And this crash is purely speculative. So there's nothing crashing the environment. In the economy. There's no bubbles. There's no wars. There's no. The bubble, you could argue, is in asset value of these equities. They've been going up so high for so long, and fundamentals are good, but maybe not as good as the markets represent. So we have a crash based on the overvaluation of the stocks, and it just got to a point where there's not enough people still looking to buy. They start to move lower, fear kicks in, and everybody sells off. Now, due to the fact that the economy is still strong, I do believe this will recover. I don't believe this will be a sustained drop. It was a very drastic sell-off, and we'll see how this week ends tomorrow. However, I don't think this is anything to worry about. I just want to show you guys how these emotions correlate into the markets, how you can tell the human emotion aspect that goes into trading and how relevant it is in the markets. And even if it's not a human actually sitting there trading, it's a human telling the robot to get their money out of this and go into that. It's a teacher calling their friend that manages some extra money they have on the side. It's a doctor's stockbroker who's got his big chunk of money sitting in some funds. It's everybody and anybody who has money tied to these markets seeing this happening and panicking, and that causing them to react. Reactions causing them to switch their money to something else. Japanese yen is one of the places that money goes to be safe in times like this, and it appreciates when the stocks depreciate typically. So I just wanted to tie this lesson together for you guys, give you guys a little insight on some correlations in the FX markets, as well as some market psychology, stock markets. This stuff is all relevant in any market, although, like I told you, the sell-off crash versus the increase isn't really as relevant in Forex because there's not so much of a there's more of a pairs trade, and there's always two things being lined up in every transaction. However, you still can see the yen react to mass psychology and human emotions and fear, greed, and all that kicking in, reflecting into the FX markets. You can see the New Zealand dollar, Australian dollar, Canadian dollar. They're the risk on assets. They're the growth currencies. The higher risk in booming times money goes to them. You'll see them sell off in times of this. So these are all things that tie into the FX markets, and they're correlated throughout all the markets, and it's something that we definitely want to be aware of. And you should know if you're a trader, whether you're a pure technical or not type of trader. This is stuff that is relevant and you should know. All right, I hope you guys found some sort of value in this. Please subscribe and like my videos if you like what you see here. Check me out, core.fx on Instagram, as well as my website, corefxtrading.com. I hope you guys enjoy these videos. Thank you for taking time to watch them, and I will catch you later.